important topic as we are all going through, both as investors in passive and active investments in real estate, stock, and every other investment out there is obviously affected. We are all feeling the situation with the quarantine and the COVID crisis just coming on pretty suddenly, I'd say. Some people saw it coming, others like me didn't pay attention until it was like really on us. We are here today to discuss and understand the effect of the COVID crisis on lending matters. John and Anton are from Peak Multifamily Lending, and they're here to talk to us about not just the lending options and what options we have for forbearance, and if your property is in trouble, or if you're an active investor, or if you're even a passive investor, what kind of questions you should be asking your sponsor about these investments, about the different lending options right now. The CARES Act has also put like a 120-day moratorium on evictions. And obviously when you are in a class B or C space especially, this does affect us because when tenants can't pay, you really can't evict them and you can't get a better tenant into place. So we have a lot of programs out there, the forbearance programs, that we can write it out, but obviously we don't want to use it until we need it. So I wanted to use this time with Anton and John to talk through what is the situation, what are they seeing, what are some options for us as investors to look into. Again, nothing here, please consult it's just a quick disclaimer. Quick housekeeping rules, please ask your questions in the Q&A box. Just makes it easier for me to track. I will have this webinar recorded and sent out to all the attendees. And also, if you're looking for the recording, please make sure to whitelist my email address so you can get it into your spam folder, not get it into your spam folder and actually get it into your inbox. I get a lot of questions on this, so I just wanted to clarify that. If you have any issues with audio, visual, or otherwise, please type it in the chat box and let me know ASAP. I'm Kavita Bartake. Most of you are familiar with me. I am a multifamily syndicator. I spent about 19 years in IBM and Atlassian, and moved into multifamily about 3 years ago and full-time last year. I have a master's in computer science from College Station, Texas A&M. And luckily, I've found that so far I haven't been hit very hard with my own rentals, and I got 100% of my collections in April 2nd. So I'm very pleasantly surprised in spite of everything that's going on. And I'm also happy to share with you some resources that you can share with your tenants in case they're hit by anything as independent contractors or as employees, unemployment and SBA and other resources out there for them. And I do have a webinar on that coming up next week. Please do attend it for yourself, whatever situation you are in. I am a multifamily investor, about 2,200 doors. I'm passive as well. With that, I want to introduce our first guest speaker, Anton. Anton has been on a webinar before with me, and he's spoken about lending and doing due diligence on multifamily investments. He has decades of experience in commercial and investment banking, private equity, and commercial real estate. He's a graduate of Zurich Business School in banking and finance, and has held senior management positions at major financial institutions throughout the world. He's managed cross-border teams and financed and restructured several $1 billion of commercial real estate. He's also, over the last 15 years, advised family offices, high net worth individuals, and private investment funds in directing their investments in commercial real estate. So our guest speaker is obviously very experienced, and he's also a multifamily lender right now. So he speaks to us with his experience and shares his experience. Thank you, Anton, for being here.
Yeah, thanks for having me.
Our second guest speaker is John Martinez, and John works with Anton, and John is here to talk more about the Freddie Mac side of things, the small balance. He helped actually kick off the small balance loan program with Freddie Mac. So he brings a lot of experience in commercial real estate lending to this webinar and to our investors today. He has worked in several mid-tier and boutique investment banks, providing underwriting, research coverage, and other key roles, serving other key roles for these institutional investors. He has a BA in finance and accounting and enjoys running, cycling, and fishing. I don't know how all that is going right now. Hopefully you're getting out there and doing some of these things, John.
I can watch other people do it on YouTube. It's great.
All right. With that, I'm going to hand it off to Anton. Anton, do you want to share your screen?
Sure.
Go ahead.
Okay. So can you see the slide, the first one?
Yes, I can see it.
Okay, very good. So thanks for having us on COVID. Really appreciate it. Obviously, we have a very unique situation we are facing right now. None of us have seen anything like this before, have gone through multiple downturns. When I started out first, I worked in New York, and in the early 90s, one of my first jobs was to help out with commercial loan workouts for German and Swiss companies. That's where I was born in Switzerland, and a lot of them invested in the US in the 1980s, mostly in shopping malls and large office complexes. So all the talk today of dying shopping malls, that actually we already have seen that once back in the late 80s and then in the 90s. I also worked in Asia. A lot of that also involved working out bad debt and restructuring of corporate debt, as well as real estate portfolios. And obviously, if, many of you have also experienced the last great recessions where I went through too. So even though I have gone through multiple downturns and workout situations, I would say this one is completely different because we have never seen a government-driven economic shutdown like this before. We have seen some smaller situations where maybe in a particular area everything was shut down due to terrorism or to a natural disaster, but we have never seen it on a global basis as we are seeing it now. And so I think anyone who is pretending that they know what's going to happen, whether it's a V recovery, whether it's an L recovery, a W, U, whatever it might be, a Nike swoosh, no one really has a clue, right? So it's all about essentially guesswork. But my view about all this is ultimately our economy is driven by businesses and by consumers, and it's driven by confidence. And I think it will take time. There is, in my view, no doubt that we will bounce back very significantly once we can reopen the economy. That is kind of obvious, but believing that we are just back to normal where we were back in January and February, I think is really unrealistic, because the confidence by consumers and businesses will be lingering on the negative side for quite some time until everyone feels comfortable again, right? So that's kind of just my introduction and my view on this. I might be completely wrong. I do not have a crystal ball as anyone else, but I would say be warned if you think that it's just a very quick recovery and we are back to normal, because the confidence by consumers and businesses is that crucial. So just wanted to quickly make a couple of comments about us as a firm and myself as well as John. We have combined more than 50 years of experience in multifamily lending. We also have quite a bit of knowledge and personal experience in investing in multifamily properties. So we have been on both sides. We have done more than 5 billion in lending transactions, and we have closed thousands of transactions over the last 30 years. We have access to hundreds of lenders. We are a commercial mortgage broker, so we can find the right broker, the right lender for the right situation. And I know until recently, a lot of sponsors felt that they can go directly to a lender, and in some instances it worked. But I think they never really realized that the lender is essentially just padding their rate when they know that they don't have a competition at hand. So ultimately, it doesn't really help that much to go direct to start with. But in the current environment, I would strongly advise not to attempt it, because all the deals that I've mentioned before we officially started, where we were asked to help in rescuing these deals. Most of these deals, the borrowers went directly to lenders, and when I look at some of the lenders that they have chosen, it was a clear signal to us that they did not really know what they were doing. They didn't vet the lenders, they didn't investigate whether these lenders were serious lenders, whether they can close. So I would say in the current environment, it's probably more important than ever to pick a mortgage broker that actually knows what they're doing and that understands the multifamily space extremely well. So John, would you like to say a couple of words?
Yeah, sure.
Just
Anton.
introduce yourself.
Yeah, so John Martinez, been working with Downtown Manly for the last couple of years, and have had experience working within Freddie Mac. So I kind of have a feeling and insight as to some of how how the agency kind of processes through their thoughts when they have to reset in an environment like this, and a bit of kind of what's going on downstream with relationship to lenders, how they're interacting with agencies, and the information flow that they're getting that Anton will speak about in a second. And essentially kind of would like to highlight that, a lot of what we'll present is what has come out here recently, but, things can change and very likely may. So, not to be doom and gloom, but just, we're in a period of some uncertainty. We're here to provide as much information and timely as possible, and we'll be sure to update you guys as soon as we see anything materially change in information that we present here.
Okay, very good. Thanks, John. So let's start with Fannie Mae, and then we can move over to Freddie quickly. You have heard a lot probably over the last week or so on Facebook and other social media. There are a lot of people that come out with information. Some of it is accurate, some of it is not accurate, some of it is outdated. And in reality, everyone has been struggling to get the right information out, and Fannie has also provided that information somewhat on a piecemeal basis, because they first just came out on a verbal basis what they were planning to do, and then they came out formally with guides to the lending community. When it comes to the underwriting elements that really have tightened quite a bit, I would say one that stands out the most is only the principal and interest and taxes requirements. So you have the principal and interest that now actually it's the taxes is included there, is excluded there. So that's an error from my side that I need to change in that slide. I just prepared it briefly before we started. So just assume that PITI is just the principal and interest, not the taxes and insurance. So to be clear, for principal and interest, when it comes to the so-called Tier 2 loans, and for those of you who are not familiar with it, Fannie operates with tier structures. The the tier 2, tier 3, and tier 4 are the most common ones. They also have some other tiers, but let's not delve into that. The tier 2 is essentially the highest leverage. They can go all the way up to 80% and 1.25 debt service coverage. And then tier 3 is up to 65, 1.35 debt service, and tier 4, 55 and 155 debt service coverage. So the big difference really from before is that now they require 12 months of principal and interest, and for loans under 6 million, 18 months of a reserve. And that's even if you're an interest only loan, you still have to pay, you have to put 18 months into the reserve. So that's a significant amount that you have to put in there. As your leverage goes down and the debt service coverage goes up, that is then getting lower down to 6 months. And if it's a 55 and 155 leverage and 155 debt service coverage, then it goes away. So if you're a syndicator or an investor that has third investors in the deal, that means you have to raise more equity, which means that returns for you and your investor goes down. So that is a significant change. Obviously, the reason for that is very simple, because no one really knows in what directions we are going. Fannie, and when we talk about Freddie, it's the same thing. They want to be sure that there are enough reserves, not just on your own, in your own bank account that you have control over, but that the lender has actual access to cover any shortfall. And so it's only very logical what they have implemented here, but that doesn't mean that it's easy to bear from a borrower perspective. What is important to know is it's capped at 10% of the loan amount. You can say, well, that's good to know, but it's still a very significant amount, obviously. One of the items that's also important to understand is that you can draw from that principal and interest reserve account to cover any shortfalls if you have any shortfalls, right? So that is at least a positive element there. So you essentially forward cover that risk for having any shortfall, and instead of having it in your bank account that you can control yourself, it's in the lender's account. But in a way, you would have to say, if you go into a new deal today, you really should do that anyhow. Maybe not for 18 months or 12 months, but certainly for a significant amount of time, just to be on the safe side. Now that stays in place for 12 months until you reach that minimum tier debt service coverage. And it can last all the way up to 3 years if you are struggling to get to that debt service coverage that you were originally applying for and have the loan agreement for. Also, commercial income for properties that are mixed use. They will not underwrite any commercial income except when it's for essential businesses, i.e. grocery stores or anything else that needs to stay open. So that's on the Fannie side. On the Freddie side, it's essentially they apply just a little bit of different debt service coverage structures. Their principal and interest, again, I'm sorry that I didn't see that I put in PITI when it's really just the principal and interest. So just assume that, and I will send you an updated slide, Kavita, that shows just the principal and interest there. It's less than Fannie, so that's the positive part for most instances. For student housing, it also can go all the way up to 18 months, which is not really a surprise. Freddie SBL, maybe you can speak to that a little bit. John has its own rule. It's very common that the Freddie SBL side is different and has different rules than the conventional side. So go ahead, John.
John, it looks like you're muted or you're not able to unmute.
There we go. Sorry.
Okay.
Yeah, so what we're dealing with on the Freddie side is the 12 months. And as far as that escrow requirement will be in place for obviously for the life of the loan. So these are changes programmatically. And so, you know, in that respect, that's probably part of why we also saw some of the benefit in pricing was with these types of programmatic changes and mitigating some of the perceived credit risk, you get this improvement. And then obviously also, as we have on the bullet here, for properties that are over 50 units, you know, that there will be a requirement for reserve replacement that also gets escrowed. So, you know, Freddie had been previously a little bit more aggressive with regard to escrow requirements versus Fannie. But in this instance, with this type of uncertainty, you know, for these loans going forward, that will be the case, that there's more of a conservative standpoint, you know, and hopefully we maybe would see some of these program changes change over time as there's a change in the environment in multifamily in the market itself.
Are you folks already seeing the effect of this in terms of increase in cap rates as far as when the properties are getting retraded?
No, not really. I think it's too early to tell. Now, when it comes to appraisers, right, and that's really more of an appraiser question. For them, it's really a challenge because historically they always look at history of comps rather than looking forward. So ultimately, I think the valuations probably are not going to change from a appraiser perspective. They will just have disclosure within the appraiser that says, look, that doesn't take into consideration any changes due to the COVID-19. And the lender then will make just their own assessment whether they need to make an adjustment to it or not. But when it comes to the actual deals that are out there, I personally haven't really seen any deal that has been retraded from on a cap rate basis, but has been more retraded with, or let's put it on hold, or we are walking away completely. Mm-hmm. Because you cannot really come up with a new cap rate here. All what you can do at this point is point out we don't know where the collections are coming in, and based on that we need a discount. So we will see only over the next 2 weeks or so for these deals that are still under contract and are going into a retrade between buyer and seller. I suspect that topic is going to come up at that point, but to actually see a pattern in cap rates, I would say that will take some time until we see truly a true pattern of whether cap rates have been changed or whether it's more driven by reductions in NOI that is caused by the lower collections. So commercial income is essentially the same as with Fannie. Now, when it comes to release of the reserves, it's more on a case-by-case basis. I feel it's a little bit more complicated with Freddie than it is with Fannie. Obviously, with Freddie, it always has to go back to the Fannie for final, to Freddie for final approval anyhow. So you need, obviously, similar with Fannie, you need to meet all your debt service coverage requirements and so on. But it's more kind of reviewed on a case-by-case basis, whether they want to release it or how much they want to release it. One other element is that they have, for certain markets, they have given the message that they are going to lower the leverage as well as increase the debt service coverage. The leverage typically by 5% lower, and the debt service coverage by 10 basis points higher for certain markets like oil and gas would be Houston, and for tourism, obviously Vegas, New Orleans, and Orlando are perfect targets for that, but that's not an exclusive list. They may add other places. Certainly when it comes to the Permian Basin in West Texas, that's definitely on that list too, right? So, and it might be some other cities and towns that are heavily dependent on oil and gas, as well as on tourism. So just that you are aware of it, that is only if you have a property that you look to buy and to finance or refinance in these markets, it will definitely be much more scrutinized. Freddie has specifically highlighted that. With Fannie, that has already been the case to a large extent when it comes to Houston. Houston has been on the pre-review list for a long time. But when it comes to Vegas, New Orleans, and Orlando, they haven't been on any list with Fannie, but there is no doubt that they will take a similar stance in these tourism-dependent markets too. So let's quickly talk about forbearance for those of you who are already in a deal or invested in a deal where their sponsors might consider it. They are all very, very similar when it comes to the forbearance, which is not really a surprise since it essentially came down from the FHA, and Fannie and Freddie need to execute along those lines. It's for 90 days in initial forbearance all the way up to August. The repayment period is for 12 months, and you need to have a so-called hardship requirement. You essentially have to present your case. Now, again, how that hardship is exactly being looked at, that's on a case-by-case basis. With Fannie, so what we have heard so far is that lenders feel that if you are dropping at that or hovering around that 1.0 debt service coverage, that would be then good enough for a hardship. But if you are at slightly below 1.25, it probably won't be sufficient. The forbearance agreement is non-negotiable, so it's not that you can start a negotiation with any of your lenders. It is what it is. Legal fees with Fannie, they initially it's $750, but then it's still additional fees that need to be reasonable. So no one really knows how big that is. Now, when it comes to evictions, and you probably have heard about that through other channels already, you're not allowed to evict during the forbearance. That is quite obvious. But the big difference between Fannie and Freddie is that with Fannie, you're also not allowed to evict during the repayment period of the forbearance. So you have up to 12 months to repay that forbearance. Again, you don't have to pay any interest and any fees on that. So on the surface, that's a very attractive program where you essentially can have a forbearance for 3 months, and then you can pay that back over a 12-month period. So that alone on its own sounds really attractive. But unlike on the Freddie side, where at least up to now they have not given any indication that you would not be allowed to evict after that repayment period has started, with Fannie, it has been very explicit where they said that you cannot evict tenants during that time. And at the same time, for anyone whom you have not evicted, you need to offer them a payment plan for the past due rents too. So it's pretty draconian. So I would be I would think twice whether you really want to get into that situation where you have to either pay the whole forbearance back after just 3 months, which in my view is not really long enough of a period to recover, or then to pay it back over a 12-month period, and then you have essentially no ability to evict anyone for another 12 months. So that's a really harsh rule, and so certainly from that perspective, the Freddie program looks much more attractive. For required documentation, it's really very similar. You have a pre-negotiation letter with Fannie, you have a hardship letter with Freddie, but ultimately it's essentially the same thing. And obviously, you need to provide the typical information that you would expect when you ask for forbearance or a loan modification from another lender, which are rent roll, collection, delinquency report, your profit and loss statement for the property, but also for your own balance sheet, right? So it's not just a property statement, but also your own financial situations as a borrower. Also expect that you have to provide all the PFS and REO schedules that are completely updated for the various guarantors for these loans. So just that you essentially are ready. Again, really the key difference between Freddie Mac and Fannie Mae is that that language that they so far have in with Freddie, with Fannie, that is not there with Freddie. Let's hope that Freddie sticks to it, and or that Fannie will remove that clause. But as it is now, as I said, I will be extremely careful to take advantage of that Fannie forbearance unless you really have to, because that really can bite you big time when you're in that situation. Do you want to add anything to that, John?
No, Anton, probably just the only thing I'd add is that because both the agencies have the same regulator, it's you got to think sometimes of the regulator as the parent and trying to get the kids to act and play well with each other. And so I would just say, hopefully not the case, but it would not be surprising if we saw Freddie revise that at some point in the future, simply to be able to be in line and not take any political heat from the regulator. So those are considerations that sometimes work their way into the program details, and just putting it out there that is a possibility. I wouldn't take it off the table.
Yeah, very good point, John. So what should you do when you're a current multifamily owner and you're in the situation you're in right now, right? So you've Kavita mentioned she is one of the lucky ones who has been able to collect all the rent, and that's great. I would say there are certainly some owners that will see a significant delinquency. It will depend a lot on the market they are in, what the employer base looks like for the tenants, and also just on the general quality of the tenant base, right? So no one really knows how bad that fallout is going to be. The stimulus package may or may not help, right? In the C-class space, you have to recognize that yes, they may get now a pretty big check over the next couple of months, but that check can easily be used for other items than for paying rent. So obviously it depends a lot on how you handle these tenants. But particularly in the C-class space, you probably struggle more to convince some of these tenants that they should use a portion or all of that stimulus money to pay your rent. Now, when it comes to the lender, what we recommend is really reach out to the servicer of your loan or for your loans. Start that communication before everyone is reaching out to them with forbearance requests and or really problem situations where they tell them, look, we cannot pay our next mortgage payment. So services will be completely overwhelmed with requests from different lenders. So you have a couple of more days left. I would say that you have the ability to reach out to these lenders. And after that, it will be very hard to start that communication. It's really important that you find out what the exact process is with each lender. Every lender has a little bit of a different approach. Obviously, you have the pre-negotiation letter with Fannie that they can provide you with, and Freddie that can give you draft hardship letters, whatever it is. But ultimately, every lender has a little bit of a different process. So it's important that you find out what you need to do. Now, we have always, so far I've talked just about Fannie and Freddie, but you should also do that when you have a bank loan, a bridge loan. With bridge lenders, it will be much tougher because bridge lenders tend not to be that friendly when it comes to borrowers not being able to meet the loan agreement. So there, it all depends who your bridge lender is. Some of them are more friendly than others, and some are very aggressive in doing the best of times. And I do not see them to now suddenly to be cooperative just because COVID happened, even though it's not your mistake. They may just take advantage of the situation. When it comes to banks, particularly banks that have the loan on their own book, on their own balance sheet, there you have the best chance to ask on a more informal fashion for loan modifications. And for these type of loans, I would definitely reach out to them, even if you do not have really a financially distressed situation. Just ask them what they will be willing to offer. I know of multiple cases where a bank was willing to offer a lower interest rate or interest only for a certain period or extending the loan, whatever it was. So particularly smaller community banks and credit unions, or you may have that chance to do that. So I would certainly pick that up. Another recommendation is go through your loan documentation line by line, understand what your requirements are, what you need to follow, are your reporting requirements, and particularly when you have a non-recourse loan, what potentially could trigger a recourse. Read through that you really understand what could trigger it, so that you're not caught on the wrong foot there. If you have any doubt, talk to a lawyer, right? Because that's really important. With the agencies, it's because it's kind of a regulator directed forbearance program. I don't think that is really triggering a recourse. I know some lawyers out there said that don't even ask for it. You have to risk that you potentially are exposed to a recourse trigger. But with other lenders, it could be, depending on the language in the loan agreement, when you state, oh, sorry, I cannot pay. So you have to be careful there. Also, when you have still pending draw requests for rehab and replacement, make sure that you push that through the system, that all the requests are in, the documentations are in, and ideally push that you get these paid out as quickly as possible, again, because the services will be completely overwhelmed. Also make sure that all your financials are completely up to date, so that if you want to go for a forbearance or loan modification request, that you have everything ready, right? And lastly, Kavita already touched on it, the CARES Act. You have options there as a property owner with the various programs. Take advantage of those. But I would recommend to talk to your CPA, so that the CPA can help you to determine which program you should apply first and in what way, rather than just rushing out and file applications. So that it's kind of a coordinated approach with your CPA. I would also recommend to go with your existing lender, not for the loan itself, but for the operating account. And if you already have an SBA relationship for another business, then I would say go with them. It will be a complete madhouse starting tomorrow with all these lenders when it comes to these loans. So having an existing relationship will be crucial there to get things through. If you don't have a relationship, I would say talk to a SBA broker, loan broker that specializes in SBA loans. Like, we would not be one of them, right? We could technically broker an SBA loan, but we would never recommend to use a commercial real estate broker or someone who is a jack of all trades. This needs a broker that is doing nothing else but focuses on SBA loans. But again, the best thing is really if you already have a banker relationship, that you can go through that bank relationship. So what should you do when you have a loan under application, right? So that's different when you already have a loan, but now you have already a signed PSA, you have already signed that loan. So what should you do now, right? So one of the key elements is, right, and we hear it a lot now. They didn't retrain me. I already have a loan application. It looks great. They promised me that it's not going to change. That all sounds good, but we have seen plenty of deals that have blown up at the closing table. So whatever the lender or the broker tells you that everything is fine, look further behind the curtain and try to find out whether it's really fine or not. So I would also assume that you will have lower loan proceeds because they still can retrade you. Even if they close, they still could retrade you if your collections come down or the seller's collections come down pre-closing over the next week or so. Some lenders purposely extended the closing that they can see where April collections are coming in. Also, obviously, we talked about reserve requirements, like for agency loans. If you do not have already that loan commitment, you are going to have to go with the new reserve requirements. It's not that because you already applied for that loan, it doesn't apply to you. That is still required, so be aware of that. So as a result, you need to raise significantly more equity to cover the principal, interest, taxes, and so on. Again, sorry, if somehow that PITI just self-added itself, which obviously is just principal and interest. And work with sellers to extend the closing date. It's impossible to close a loan within the normal time frame. Usually we can close within 45 to 60 days. Now you have to expect at least 90 days, depending on the location and how severe the lockdown is. It may be another 30 days on top of that. So be prepared for that and negotiate it also with the seller. Usually sellers understand that, right? That you need more time, and they are more than happy for you to stay in the deal than playing hardball there. If you do not have a non-agency loan that you have applied for, whether it's a bridge loan, whether it's a bank loan, whether it's a private money loan, particularly CMBS loans, look for alternatives now, because more likely than not, you will face potential retrade or a lender telling you later on that they cannot lend at all. With banks, I still would investigate whether the bank works it off their balance sheet or whether they are funded through another party, because we have seen banks that even though they claim that they are balance sheet lenders, they ultimately went and said that they cannot fund because they used third-party funding and would also securitize those loans. So just be aware of that. If you have, lastly, if you have a deal with a signed LOI, so you're not under contract yet and not under a loan application yet, sorry, it's a little bit easier for you because you're still early in the game. Hopefully, if you do not have already hard money in play, then it's essentially you can decide whether you want to walk away. But let's assume that you don't want to walk away. When it comes to loan side, here it's really now crucial that you pick the right horse. Do not attempt to go directly to a lender because you just do not know which lender is the right lender. Right? There are so many lenders out there that have stopped lending, and some of them claim that they are still able to do loans just to get you into the door, get the application fee, and ultimately they may not be able to close unless the market drastically changes over the next 2 months or so. So it's extremely important that you pick the right horse right from the beginning. Now, again, talk to your broker and lender about your principal and interest, insurance, taxes. Also assume that you potentially have a lower leverage, that you have a higher debt service coverage with a bridge loan, a higher debt yield, whatever it might be. So be aware of this. And also underwrite your deals based on assumptions that your collections will come in significantly below of what you currently have with the T12 maybe for February, and you may get already have the collections for March, that you are accounting for that potential drop in April. Also, do not just think that just because April came in fine that you may not see a significant drop in May and June. It could well be that in initial phase, the tenants were still willing and able to pay for April, but that they may drop off then the cliff in May or June. So it's important that you have that in mind. And again, also here, just negotiate a closing date where you add at least 30 days, ideally 60 days, to what you already had at 60 days or 75 days before in your contract. And very important to add contingencies in your PSA for financing, minimum physical occupancy, as well as minimum collections. Particularly when it comes to the financing in strong markets and major markets like Dallas, Fort Worth, Atlanta, Phoenix, and so on, you were not able to add a financing contingency until a couple of weeks ago, because you were always beaten by a buyer that was willing to go hard without any financing contingency. Now, obviously, that has changed completely, and you must have that financing contingency in place. So that's really absolutely crucial there. John, do you have anything to add to these three scenarios?
Just anything I'd add on from the prior slide, just backpacking. Like you mentioned, for deals that are in play now, if you're going to a bank, try to also get a feel for their appetite. It's kind of hard to maybe get that out of the origination function if a bank is the solution that happens to work for you. But you want to have a feel for whether or not, like you mentioned, if they're keeping it on their books or if they're selling it off, maybe they're syndicating the loan. But also just what's that bank's outlook for wanting to continue a concentration of multifamily loans relative to their capital? Because it may be the case that they're happy to, like you said, to kind of get you signed up, but they're not willing to verbally commit to the idea that in even within 30 days that the credit committee might come through and say, well, you know what, we're full up on multifamily. Anything on the book, if it's not closed, we're not closing it. So you don't want to get stranded like that, and just feeds more to your point of wanting to have additional lengthier contingencies built into your PSA.
Yeah, very good point. Yeah. So Kavita, would say we can open it for questions if there are any questions out there.
Yep. I have one question. So how are people who are under PSA, under contract right now, dealing with due diligence with all the restrictions in place with the quarantine? How are they even able to walk units or do any of the due diligence?
Yeah, it obviously depends on each market, right? Some markets it's a little bit easier. the biggest challenge really is to get people on site on one hand, right? It's not just your own due diligence that you do as a sponsor and borrower, but also to get the third parties from appraiser to property condition assessor, maybe a lender representative, as well as us on site to travel restrictions. To give you a perfect example, we could not travel to Louisiana, we could not travel to New York, other than being quarantined in Texas for 14 days just to go and visit a property. So that's only is a challenge where you essentially would have to find someone who is in that market to do that inspection. So that is the travel restrictions that come into play. And once you are able to get onto the site, the outside is not really such a big deal. The biggest problem are the unit inspections. And for obvious reasons, the tenants do not really want that someone comes into the unit. And both agencies have implemented different ways of how these inspections could take place, either through the window, through the door, opening the door, just looking in without actually walking the unit. We haven't really seen any situation yet how that in reality is going to work. But certainly the agencies have shown willingness to make adjustments to the inspection process. What I suspect also is going to happen is once, even if an inspection is done kind of more on a limited basis without a direct detailed access to the occupied units, that they may then say, once the restrictions are lifted, we are coming back and want to do another inspection after that, just to verify what we believe the units look like, right? The challenge really is in the past, it has been relatively easy to inspect occupied units without the tenants being there to a large extent, because they were out working, or a significant number of them were out working, but because of the stay at home or shelter in place orders, there have never been more tenants that are actually at the property now on a day-by-day basis, right? So with that, it's just much more challenging, but it's only doable. But it will solely, you have to expect that it's, again, depending on the location, that it takes 30 days, and in the worst case 60 days more until you're actually able to close, compared to the usual 45 or 60 days.
Right. Yeah, I've even heard in single family homes, they're doing drive-by appraisals now. So drive-through appraisals, so they don't really get inside the units anymore, which I thought was interesting.
Yeah.
I have some other questions here. I've read that agency lenders tighten the rules in terms of sponsor team strength and story of the deal. Can you elaborate on that a bit?
Yeah. Do you want to talk to that, Sean?
Yeah, I was visiting with the lender today, Anton, and one thing to kind of keep in mind is a little bit of backtracking to give context. Anton and I have seen, as he's mentioned earlier at the beginning of the conversation, folks bringing to us opportunities where, unfortunately, a lender, wasn't able to close, or something fell apart in the deal from a lender standpoint. And if it's an agency lender, that kind of highlights what had been going on within the capital markets prior to the Fed stepping in, providing additional liquidity. So without getting too deep into the weeds, if you're a licensed lender, let's say on the Freddie Small Balance Program, there's kind of different flavors. There are different type of financial entities. They could be a bank, they could be a standalone lender, they could be a REIT. And so within each of those three buckets, you have different access to funds to be able to fund and subsequently sell the loan to Freddie on the back end, and all of that is impacted by the liquidity that's in the larger market. And so what's kind of occurred recently is that most of the lenders have been focused on the current book of business because they're trying to maintain themselves as a going concern. And so they want to be able to close loans that had gone on their application, loans that have been submitted, and we're waiting commitment letters from the respective agency so that they can close deals and maintain those relationships with the mortgage broker and not blow up themselves from a cash flow perspective or get stuck with maybe if it's a loan that they hadn't been able to sell off to one of the agencies. They're trying to mitigate some of the risk. And so the look forward is essentially kind of the 6 inches in front of their face, looking up to think about new business and acquisition financing. Speaking with 2 lenders today, while they'll say that they're kind of in the market to continue to do acquisition financing, and I believe that that's the case, they're really messaging that, but they're really thinking about wanting to not really touch a new acquisition application until probably 30 or 45 days, because as Anton mentioned, maybe April collections are fine, but what about May or possibly even June, depending on what we see here play out within the U.S. economy. And so, as far as specifics about where the tightening is on the deal stories, I don't think, Anton, I'll let you talk to your conversations, but on my end, I've not seen a lot of specifics. Anecdotally, though, we know that there will be a new kind of an update to a program where on the Freddie side, in the past, you might have had maybe a weaker guarantor that might have had a weaker credit score below 650. That could have been either written off as a kind of mitigated in the deal profile that was being submitted to Freddie because of the strength of the rest of the guarantors. Going forward, there's a stringent, bright line. It's either the FICO is going to be over 650 for all guarantors, or they're not in the deal, where you're going to need to come in with a different structure as far as guarantors are concerned. So there will be firmness going forward. I think, and just to reiterate, I think we'll see these things evolve. It's always best to kind of do your homework and make sure you kind of bring the best deal story. Obviously, we're always going to be a resource to help you kind of vet out where we think your deal story fits in the market and to try to help match again the right lender for your right deal.
Yeah, thanks, Sean. So I think what for those of you who have been already in that in the private syndication space for a while, either you were active yourself or you may have participated in a deal. So you probably, if you have done that, you know that very often these deals have multiple guarantors in the deal. Sometimes there are 6, 7, 8, 9 guarantors in a deal. Sometimes even more. Lenders generally have never liked that. I would say most lenders and Fannie and Freddie want to see that kind of capped at maybe 5, maybe 6. But they have tolerated a larger number in the past. I think that time is over. Also, they sometimes have tolerated sponsors that have essentially no experience, that they have W-2 jobs, but even though they have the financial strength, that the lender will likely not agree in having them as sponsors on board unless a truly experienced co-sponsor comes with it. And when I mean an experienced co-sponsor, not necessarily someone who just guarantees, but actually is actively involved in the deal. As you can imagine, it's pretty scary when you think of some of the deals that are out there that have been sponsored by all W-2 employees, and none of them can asset manage a property on a day-to-day basis, other than taking a day off. In the past, that may have been doable, but looking at the current environment, the lender will say that is just not the way we are accepting sponsors going forward. So very clearly, they will look much closer at the sponsorship strength. If you are just starting out, it depends a lot on what you have been doing. If you have already done single families, to in a quasi-professional fashion, not just one or two, but if you have really invested in single family for a number of years, you have bought and sold them, flipped them, and so on, you will look that's only much more favorably than someone who just went to a coaching program last month and now decides that he or she wants to do her first deal. So they will definitely look at that real estate experience, even if it's not multifamily directly, just to determine whether someone at least has some basic knowledge that can help them. Property management companies will be more scrutinized also, and clearly when it comes to the financial strength, they will scrutinize that a little bit in more detail. John alluded to that. Credit scores, they will stick to that 650 and up. It was always been a rule with the small balance program, but they can make exceptions. Now they will likely make less exceptions to that also on the Fannie side. Past foreclosures, we were able to get them through in the past. I would say that's probably even tougher to do now. So everything essentially is being tightened, whether it comes to the property level, whether it comes to the location of the property, whether it comes to the sponsor. So yes, is it going to be harder when you just start out? But it's not just you as a sponsor, it's really the combination of everything that is just being tightened to create that additional cushion for the lenders.
Which makes sense, given the current environment, right?
Sure, yeah.
You want to make sure that the deal is successful, and with all the reserves increased, the cap rate's really not changing. It's just really a very challenging environment.
Sure. Yeah.
So one more question, and we'll wrap it up. I think we are over our time period anyway. Jorge asks, do you have bridge lenders that are still lending right now? If so, what types of rates are you looking at?
Yeah, we have still bridge lenders that are lending. We have quite a number of bridge lenders we know that have stopped lending and have walked away from deals just essentially at the closing table. So they're all of them are right out there. So that is when you are attempting to find a bridge lender, again, I strongly recommend not to attempt to do it yourself, because you just don't know which ones are serious and which ones are not. It's a wide range. If it's a very good deal in a very good location, even though it's a not stabilized property, but it meets all the criteria from an upside perspective, from a location, from a sponsor perspective, you're still able to get bridge loans that are at the LIBOR plus 275 to 300 basis points. So that's on the best side, but you can get all the way up to the teens, right? So it really depends a lot on the deal. I would say what I have mentioned with the 275, 300, that was available to a broad range of sponsors until a few weeks ago. Now that is really limited to experienced sponsors for a property in a very good location or a decent location with a lot of upside to the property. All the others expect to be in the 7 to 8% range, and then all the way up into the teens, right? So I would say it's available. You just have to, it's so much on a deal by deal basis. And I would say the majority of them are probably more in the 7 and 8% plus now than below. Simply because the lenders that are left, they now can pick and choose the best deals off the plate and will drop the rest. And then the rest is moved on to the lenders that are more quasi hard money or full hard money bridge lenders.
Thank you so much. Anton, for sharing all that information. I think this was really useful. Thanks everyone for joining in. I just wanted to say really quick, thank you to Anton and John for sharing this information, which I'm hoping it'll help not only our active investors, but also the passives to go ask the right questions to their sponsors. The next few weeks, I will be covering webinars on the CARES Act and also the SBA disaster assistance loans. Also, the following week, we'll have a webinar on how to operate your multifamily apartments we'll have an experienced sponsor come talk about increasing the operational efficiency during a crisis and how they're handling it. So please join us the next few weeks for some more webinars. Again, thank you, Anton and John, for joining us today. Thanks all and have a great night.
Thanks for having us.
Thank you.
Yeah.
Bye.
Bye-bye.